Picture this. A trader sits at their desk, staring at red numbers bleeding across their screen. They've been trading for 3 years now, read dozens of books, watched hundreds of hours of tutorials, and yet here they are again, watching another position sink into losses. They know the rules, they understand the charts, but somehow they keep making the same mistakes. Sound familiar? The truth is, most traders never escape the beginner trap, no matter how long they've been in the game. Today, we're going to expose exactly why this happens and what separates the winning 10% from everyone else. The financial markets are brutal teachers. They don't care about your experience, your education, or how many trading courses you've completed. Statistics show that roughly 90% of retail traders lose money consistently. And what's shocking isn't just the number itself, but the fact that many of these losing traders have been at it for years. They're not exactly beginners anymore, yet they're still making beginner mistakes. This pattern reveals something deeper about human psychology and how we approach risk and reward. Let's start with the most common trap that catches experienced traders: the illusion of knowledge. After spending months or years in the markets, traders develop a dangerous sense of confidence. They've seen bull markets and bear markets, they understand technical indicators, they can read candlestick patterns, and they know all the jargon. This knowledge creates a false sense of security. They believe they've graduated from beginner status, but knowledge without proper application is worthless in trading. The markets don't reward what you know, they reward disciplined execution of what you know. Here's where it gets interesting. Beginner traders make mistakes because they don't know any better. Experienced traders who still make beginner mistakes are dealing with something far more insidious. They know what they should do, but they don't do it. This gap between knowledge and action is where fortunes disappear. It's like a smoker who knows cigarettes are deadly but lights up anyway, or someone who understands nutrition perfectly but eats junk food daily. The knowledge exists, but the behavior doesn't change. One of the biggest mistakes that persists across experience levels is revenge trading. Imagine a trader takes a loss early in the morning. Instead of accepting it and moving on, they feel a burning need to make that money back immediately. This emotional response overrides their rational trading plan. They increase their position size, take trades that don't match their strategy, and often end up losing even more. The crazy part is that traders do this repeatedly, even after years of experience. They've read about revenge trading in every book, they've promised themselves they'll never do it again, yet the moment they feel that sting of loss, the cycle repeats. The psychology behind this is fascinating. When we lose money, our brain experiences actual pain. Brain imaging studies show that financial losses activate the same regions associated with physical pain. This triggers our fight or flight response, flooding our system with stress hormones. In this state, our prefrontal cortex, the part of the brain responsible for rational decision-making, gets hijacked by our limbic system, which is focused purely on emotional survival. The trader thinks they're making logical decisions to recover their losses, but they're actually operating on pure emotion. Another persistent mistake is position sizing errors. Professional traders will tell you that proper position sizing is more important than entry and exit points, yet the majority of traders completely ignore this principle. They risk too much on single trades because they're convinced this one is different. This one is a sure thing. There are no sure things in trading. Even the best setups can fail, and when you've risked 5 or 10% of your account on a single trade, a string of losses can wipe you out regardless of your overall win rate. The mathematics of position sizing are simple but brutal. If you lose 50% of your account, you need to make 100% return just to break even. Lose 70%, and you need a return of over 200%. These aren't theoretical numbers. They're the reality many traders face because they never mastered basic risk management. Yet this same mistake gets repeated year after year because traders are chasing the excitement of big wins rather than protecting their capital. Then there's the planning fallacy. Traders spend hours analyzing charts, looking for perfect entry points, but they completely neglect their exit strategy. They enter a trade with conviction but no concrete plan for when they'll take profits or cut losses. This leads to holding losing positions too long because they're hoping for a reversal and closing winning positions too early because they're afraid of giving back profits. Without predetermined exit points, every decision becomes emotional and reactive rather than strategic. The successful 10% of traders approach this completely differently. Before they ever enter a trade, they know exactly where they'll exit if the trade goes against them, and they know their profit targets. These exits aren't adjusted based on how they feel in the moment, they're based on technical levels, risk-reward ratios, and their overall strategy. The trade either works out or it doesn't, but the outcome doesn't change their plan. Overtrading is another beginner mistake that haunts traders for years. The markets are open for specific hours, and during that time there are thousands of potential trades across different instruments. Many traders feel like they need to be constantly active, constantly in positions, constantly doing something. This creates a pattern of taking mediocre setups just to be in the game. Quality over quantity is a mantra every trader knows, but few actually practice. Professional traders understand that sometimes the best trade is no trade at all. They wait patiently for their specific setups, the ones that match their strategy and offer favorable risk-reward ratios. They might only take a handful of trades per week or even per month. Meanwhile, struggling traders are taking dozens of trades, racking up commissions and fees, and degrading their overall performance because most of those trades are marginal at best. The addiction to action is real in trading. Sitting on your hands while charts move can feel like you're missing opportunities, but disciplined inactivity is actually a skill. The market will always be there tomorrow. There will always be another setup, but your capital, once lost, requires perfect execution just to recover. This perspective shift separates professionals from perpetual beginners. Confirmation bias destroys more trading accounts than almost any other psychological trap. Once a trader forms an opinion about market direction, they unconsciously filter information to support that view while ignoring contradictory evidence. They see a bullish setup and suddenly every indicator looks bullish, every news item seems positive, and every dissenting voice is dismissed. Then the market moves against them, and they're caught completely off guard because they only saw what they wanted to see. This happens to experienced traders all the time because confirmation bias is a fundamental human tendency. Our brains are wired to seek patterns and consistency. Contradictory information creates cognitive dissonance, which is uncomfortable, so we avoid it. The best traders fight this tendency by actively seeking information that challenges their thesis. They play devil's advocate with their own ideas, looking for reasons why they might be wrong before they risk capital. Lack of journaling and review is perhaps the most overlooked mistake. Ask any successful trader what transformed their performance, and most will mention keeping a detailed trading journal. Yet the vast majority of traders, even those with years of experience, don't maintain proper records. They might track their profit and loss, but they don't document their thought process, their emotional state, the market conditions, or what worked and what didn't. Without this data, every trading day is disconnected from the last. Patterns in your behavior, both good and bad, remain invisible. You can't identify which setups actually work for you versus which ones consistently lose money. You can't see that you perform better in certain market conditions, or that you have a tendency to overtrade after wins. All this valuable information stays locked away because you're not systematically reviewing your performance. The traders who do keep journals often discover eye-opening patterns. They might realize that their win rate on morning trades is significantly higher than afternoon trades, or that they consistently lose money on certain instruments, or that their best trades happen when they wait for 3 confirming factors instead of 2. These insights only emerge through deliberate review and analysis, but most traders are too busy jumping into the next trade to learn from the last one. Another persistent error is abandoning strategies too quickly. A trader learns about a particular approach, maybe a breakout strategy or a mean reversion system. They test it for a few weeks, hit a rough patch, and immediately decide it doesn't work. They move on to something new, repeat the cycle, and end up with a collection of half-learned strategies and no real expertise in any of them. This strategy hopping guarantees mediocrity. The reality is that almost any reasonable trading strategy can be profitable if executed consistently with proper risk management. The edge often isn't in the strategy itself, but in the consistent execution. However, consistency is boring. Searching for the perfect system, the holy grail, the secret indicator that professionals use is exciting. It's also completely counterproductive. Professional traders often use surprisingly simple strategies, but they've mastered them through thousands of repetitions. Market conditions change, and every strategy will have drawdown periods. A breakout strategy performs poorly in choppy, ranging markets. A mean reversion strategy struggles in strong trending markets. If you switch strategies every time you hit a rough patch, you'll always be using the wrong tool for the current conditions, and you'll never develop the experience to recognize when your approach is likely to work well versus when you should reduce activity. Technology has introduced new mistakes that didn't exist years ago. The ease of trading on mobile apps means traders are taking positions from coffee shops, in bed, during meetings, basically anywhere except at a proper workstation with their full analytical setup. These impulsive trades, taken without full analysis, rarely work out well. The ability to trade anywhere has become a curse rather than a blessing for many people. Similarly, the explosion of trading indicators and automated systems has created analysis paralysis. Traders load their charts with 15 different indicators, each one contradicting the others, and then wonder why they can't make clear decisions. More information isn't better if you don't know how to process it effectively. Professional setups are often remarkably clean, maybe price action with a couple of key levels and one or two indicators at most. Social media has amplified another beginner mistake: comparison and FOMO, the fear of missing out. Traders scroll through Twitter or trading forums seeing others post screenshots of massive wins. Everyone's sharing their best trades, their best days, their biggest profits. Nobody posts their losses, their drawdowns, their boring days of sitting in cash. This creates a distorted perception of what normal trading looks like and drives traders to take unnecessary risks to keep up with others. The truth is that consistent profitability in trading is often boring. It's the same setups executed over and over: small consistent gains, occasional losses that are managed properly, and long periods of patience. The highlight reel on social media doesn't show any of that. It shows the home runs, which creates unrealistic expectations and poor decision-making among traders trying to match those results. Ignoring macro factors is another way experienced traders still think like beginners. They focus so intensely on their charts and technical patterns that they completely miss major fundamental developments. A trader might have a perfect technical setup for a long position, but if a central bank is about to announce an interest rate decision or major economic data is dropping, that technical setup could be completely invalidated in seconds. Understanding the broader context isn't optional for serious traders. This doesn't mean every trader needs to be a macroeconomist, but awareness of major scheduled events, understanding basic economic principles, and recognizing how news can impact your positions is essential. The traders who get blindsided by predictable events are making a beginner mistake regardless of how long they've been trading. The concept of risk-adjusted returns is lost on most traders. They celebrate a 20% month without acknowledging they risked their entire account to get it. Meanwhile, a trader who makes 5% per month with controlled risk and low drawdowns is actually performing far better, but it doesn't feel as exciting. This misunderstanding of what constitutes good performance leads traders to take excessive risks, chase unsustainable returns, and eventually blow up their accounts. Professional traders measure themselves against benchmarks with risk factored in. They look at metrics like the Sharpe ratio, which considers returns relative to the volatility endured to achieve them. A steady, lower volatility return stream is actually superior to wild swings, but beginner mentality celebrates the swings because they're dramatic. Not adapting to changing market regimes keeps experienced traders stuck in beginner patterns. Markets cycle through different phases: trending, ranging, high volatility, low volatility, bull markets, bear markets. A trader who learned to trade in a bull market might have strategies perfectly suited to rising prices, but be completely unprepared when markets shift. Instead of adapting their approach, they keep applying the same techniques and wonder why they've stopped working. The best traders recognize these shifts and adjust accordingly. They might reduce position sizes during uncertain periods, switch strategies when market character changes, or simply step aside and preserve capital during unfavorable conditions. This flexibility requires emotional maturity and intellectual honesty that many traders never develop. Unrealistic expectations form the foundation of many persistent mistakes. Someone starts trading expecting to double their account every month because they saw someone on the internet do it once. When reality doesn't match these fantasies, they start forcing trades, taking excessive risks, and abandoning their discipline. If they approach trading with realistic expectations about probable returns and the work required to achieve them, their entire approach would be different. The financial industry doesn't help with this problem. Brokers advertise the dream lifestyle, social media influencers show off wealth, and everyone focuses on the exceptional success stories while ignoring the countless failures. This creates an environment where beginners enter trading with completely unrealistic goals, and many never adjust those expectations even after years of experience should have taught them better. Lack of specialization is another way traders stay stuck at beginner level. They try to trade everything: stocks, forex, commodities, cryptocurrencies, options, futures. They bounce between different instruments based on what's moving or what someone recommended. But true expertise comes from deep focus. Professional traders often specialize in specific instruments, specific strategies, or specific market conditions. They become experts in their niche rather than perpetual beginners in everything. Think about any other profession. A doctor specializes in a particular field. An athlete focuses on specific skills. Yet traders think they should be able to profitably trade any instrument in any condition. This scattered approach prevents the deep pattern recognition and intuition that comes from thousands of repetitions in the same environment. The final mistake that keeps traders perpetually at beginner level is the refusal to treat trading as a business. They don't have a business plan, they don't track proper metrics, they don't set realistic growth targets, and they don't maintain professional standards. Trading is treated as a hobby or gambling rather than a serious enterprise. This casual attitude produces casual measurable results. Successful traders have detailed business plans. They know their expected win rate, their average win versus average loss, their monthly expense budget for commissions and fees, and their capital requirements. They track performance metrics religiously and make data-driven decisions about what's working and what needs to change. They approach trading with the same seriousness that someone would approach starting any other business, because that's exactly what it is. So why do 90% of traders continue making these mistakes year after year? The answer lies in the gap between intellectual understanding and behavioral change. Reading about these mistakes, nodding along in agreement, and then doing nothing different accomplishes nothing. Knowledge is just potential power. Only action creates results. Breaking these patterns requires brutal honesty about your own behavior, a willingness to track and review every decision, the discipline to follow a plan even when emotions scream otherwise, and the patience to build expertise through thousands of repetitions. Most traders aren't willing to do this work. They want the shortcut, the secret, the easy path to profits. That path doesn't exist. The 10% who succeed do so not because they're smarter or more talented, but because they're more disciplined, more systematic, and more willing to face uncomfortable truths about their own behavior. They treat trading like the serious profession it is. They continuously learn from their mistakes rather than repeating them, and they prioritize process over outcomes. If you've been trading for years and still making beginner mistakes, the good news is that awareness is the first step toward change. The bad news is that awareness alone changes nothing. You need to implement systems that prevent these mistakes, you need accountability to ensure you follow through, and you need the humility to start over with the basics if necessary. The markets will gladly separate you from your money as long as you continue making these mistakes. They don't care about your potential, your intelligence, or how hard you try. They only respond to disciplined execution of proven strategies with proper risk management. Everything else is noise. Your choice is simple. Continue the patterns that have kept you in the 90%, or make the uncomfortable changes required to join the successful minority. The opportunity exists for anyone willing to do the work, face their demons, and commit to genuine behavioral change. Most won't make that choice, which is exactly why 90% continue to lose. Will you be different or just another statistic who knew better but didn't do better?